And then please ask me questions. That's what I'm here for. So we're going to start with Chapter 8, and specifically it's we're adding on some information as it relates to Chapter 7 that we talked about. So we're going to talk about a couple concepts in inventory. We're not going to spend a lot of time on this chapter, but we're going to talk about some unique methods that weren't covered previously in the other chapter. So we're going to talk about various items such as how we have to value the inventory at either the lower of what the cost is or the value, just when we get some obsolescent items. Then we're going to talk about the gross profit method also. Okay, so inventory, ultimately how it's valued is going to play out on the income statement, and it will also play out on the balance sheet. The income statement because of the cost of goods sold, the balance sheet because of the inventory on hand at the end of the period. Now, the inventory, basically there's a real skill in keeping the appropriate amount of inventory that you need on hand so you don't lose sales. There's also a disadvantage to having too much inventory at the end of the year because there's a cost to holding that inventory. So what they're saying here, when inventory increases faster than sales, analysts consider this a negative signal because companies are having difficulty in generating sales. So there's really a fine line to being able to predict and to purchase inventory when you need it. Mai, if you could mute your speaker, that'd be great. And then as we're talking about raw materials and work in process, those are items that will come from the initial purchases of materials to make the products and also the work in process. So basically, in that case, increases in production, analysts may look at that as a signal that you anticipate higher sales in the future. So what is the lower of cost or market? Basically, the lower of cost or market is when companies have to write down their inventory to the market value because the benefit of that inventory has declined. An example of that may be that inventory has been sitting on the shelves and it's maybe older technology. And because of that older technology, it's not worth initially what we purchased it for, and the sales have definitely decreased.
Nancy.
Yes.
If you right-click on her name, do you have the power to mute her as a host?
Let me try.
Right-click on her name.
Let me try. I'm sorry, guys.
No, you're good.
No, I appreciate you saying that. Let me try.
Because I don't think she can hear us. Under for the participants, like if you right-click on her name.
Yeah, I'm... Okay.
Okay.
I am so sorry. Yes.
Was that you?
No, that was her, but I didn't realize I could do that. So thank you for telling me that. Okay.
Sorry to interrupt.
No, I'm so glad you did. So moving on here, with the lower of cost or market, basically when inventory becomes obsolete or not worth what it previously was, then we need to write it down because we need to be conservative in our valuation and report the inventory at either the lower of the cost we purchased it for or the market value. Again, the goal here is conservatism, and as you see here, represents more of a true value on the balance sheet and in the income statement when those assets decline. So lower of cost or market rule, again, conservative with, or in line with the conservatism principle. So we'll talk about how that works. When we apply the lower or cost or market rule, we need to estimate what the market value is in the inventory, compare it then to the cost to determine which is lower. Now know that generally speaking, companies aren't going to want to write down their inventory because a larger inventory shows greater assets on the balance sheet. Usually this will happen because if they're going to be audited, that will be something the auditors are going to look at. But generally speaking, they're going to want to show larger values than smaller values. Under the lower of cost or market rule, the market value is coined the replacement cost. So that's really what would the company now have to pay for that item to be put in their inventory. So again, the assumption here, iPhone 4s back 3-4 years ago were probably purchased by Sprint for a certain dollar value. Today, if they had those same iPhone 4s in their inventory, they are probably purchasing those iPhone 4s for a much cheaper value or cost than what they were purchasing them for 3 years ago, just because of the technology changing. So that's basically what we're talking about, where they would need to write them down at really what they could purchase them for today. Replacement cost valuation is really more relevant and it has more of an accurate value than the cost the company may have initially purchased it for. So we're talking about, for the most part, obsolete inventory. Replacement cost. How we measure replacement cost is based on an upper ceiling and a lower floor. So it's really based on the net realizable value. The market value shouldn't be more than the realizable value. The estimated selling price in the ordinary course of business minus reasonably predictable costs of completion and disposal. Now, also, it's nice to have some piece of a profit margin. So the market value shouldn't be less than the net realizable value reduced by an estimate of a normal profit margin. So basically speaking, there's not always other available items to go out and purchase on the market. So if that's the case, if Sprint could go buy an iPhone 4 today, then it's pretty clear what that replacement cost would be. If there's not such a product out there, then here are some manners in which companies can determine what that replacement cost would be. Here's an example. Sahara has inventory with the following characteristics. There's the selling price. Along with that, there's packaging cost, transportation cost, and what is termed a normal profit margin on this product. So the constraints on the market value would be, we'd take that selling price, we'd subtract out some costs in order to get that sold, the packaging, the transportation, the profit margin. So the net realizable value less the normal profit would be $100. That's the floor. Now, as you see here, here it says the floor. So this is the bottom value that would be realistic in showing as a fair value for lower of cost or market. How do we go about this? We first determine the market value. From there, we calculate what the current replacement cost is, or we calculate the ceiling or the floor, and we come up with a middle value. Then we look at the market value, compare it to the cost, and then from there look at the lower of the selected market value or the historical cost related to that inventory. And then ultimately show that on the financial statements, because we may have a loss in inventory that we'll recognize in this period. So again, lower our cost or market. The way we'd look at this, our ceiling is what we would call the net realizable value. The floor would be the net realizable value minus the profit margin piece. And in the middle probably is the replacement cost. So we're going to take either the lower of cost or market, and if there is, if we have to take the lower of the market, we will show on our financial statements in the period we write that inventory down a loss. So lower of cost or market, here's an example of various products, the cost that we purchased them for, the replacement cost, the net realizable value, and then the net realizable value less that normal profit margin. So you see here we're going to have different scenarios, and we can look and see what we're going to need to write down with this inventory. So as you see, if we look at these shirts, we show what the replacement cost is. Now that's higher than what our cost is. The net realizable value is higher than the replacement cost, but the net realizable value minus the normal profit is at $28,000. Our cost is at $28,500. So we're fine. We don't need to show a loss here. The replacement value cost is definitely in the middle. Our net realizable values, the ceiling, the net realizable value minus the normal profits, the floor. And as you can see here, there's no need to write that off because we're right where we need to be. When we look at the pants, our cost in those pants, $44,500. The replacement cost here is $43,000. So our ceiling's $46,000, our floor is $41,000, but our replacement cost is $43,000. We purchased them for $44,500. So we're going to need to write off a $1,500 loss on those pants. If we look at the shoes, we've got a cost of $10,000. We've got the replacement cost is $15,000, but our ceiling's $11,000, our floor's $8,000. We're fine there. Our golf clubs, we purchased them for $33,000. The replacement cost is $34,000. But our net realizable value here is $31,000. And then our net realizable value minus our normal profit is $29,000. So you see here, we're not going to be using the ceiling here is at $31,000, the floor is at $29,000, our cost in this is $33,000. So we're going to take the ceiling, the net realizable value, because we can take anywhere in between that, but we're going to need to take the net realizable value and write that off for $2,000. Our golf balls, we've got a cost of $20,000. The replacement cost is $14,000. We've got our net realizable value at $21,000. Our net realizable value minus our normal profit is at $17,000. So we're going to have to write down against the floor that $3,000, because again, we're going to look at the ceiling, the floor, and the replacement cost. So in applying this lower of cost or market rule, each major inventory category is usually looked at, or they can take the whole inventory. So it really varies how companies choose to allocate this lower cost or market rule. Generally speaking, when there is a variety of inventory like this, it would be very difficult to just implement it somehow to the entire inventory. Okay, someone just got on, and if you could mute your phone, that would be great. When the lower of cost or market rule gets applied to the categories or to the inventory, price declines of some units get offset by price increases in other units. So basically, if groups if companies use the various groupings of inventory, you're going to have lower losses applied to items specifically in inventory. So let's look at this example here. We've got our shirts, pants, shoes, golf clubs, and balls. Now, instead of previously, we took each item and looked at it and then determined if we needed to write it off. Here we're taking groupings, groups of clothing, and groups of equipment. So as you can see here, if we put it all together with the clothing, our cost is 83, our market's 84. If we look at the 28.5, if we look at the lower of cost or market rule to specific items, we're looking at the shirts of 28.5, the pants of 43, the shoes of 10. So we take each of them and we lump them together, and we show our and then we do the same with the golf clubs and golf balls. And if we take our lower of cost or market as a total, we're at 129.5. When we combine our inventory categories, then we're at 131. So as you see, based on individual items, our lower of cost or market is the lowest figure, 129.5, which ultimately means we'd have to write off 6,500 there based on our cost. But if we take inventory categories, we're only writing off 5,000. Then, based on our total inventory costs, lower of cost or market, you can see here we're only going to need to write off $4,000. So basically what the approach is saying here is by combining and taking all the inventory, it may result in a lower overall loss. Recording reduction of inventory to market. So how do we write down this inventory? We have two methods. One is the direct method, and one is called an allowance method. So under the direct, the loss is recorded directly by reducing the company's inventory and increasing its cost of goods sold account. Or if we choose the allowance method, it gets recorded in an inventory valuation account and also in a loss account. So here's an example. Gasparilla Golf uses the perpetual inventory method. We know that perpetual method is one where we keep it current after every sale, and it applies the lower of cost or market rules to individual items. The journal entry to record the write-down of inventory from cost to market under either the direct and the allowance methods would be, under the direct method, we are going to go right ahead and debit our cost of goods sold and reduce our inventory. So in this method, we're just going directly against our inventory, taking them out of inventory, putting it into cost of goods sold, and simultaneously reducing the value of the inventory. This method records the inventory at market. But if we go the allowance method, then instead of going directly against the cost of goods, which ultimately is an expense, and then the inventory, which would be assets, under the allowance, we're going to create a loss due to market valuation of $6,500, and then we'll credit an allowance to reduce that inventory to market. So when we do the direct method, it gets put right into reduction of inventory and offset with cost of goods sold. Under the other method, we have to show an allowance and a loss account, kind of like a contra account against the balance sheet. And also it needs to be disclosed. As you see here, inventories are stated at lower of cost or market. We record inventory reserves for obsolete or slow-moving items. We estimate shrinkage between physical inventory counts, and they're based on inventory turnover trends, blah, blah, blah. But they are providing the notes to the financial statements so users can see how their inventory is being valued. What method does Starbucks use to value its inventory? Starbucks values it lower of cost or market. And remember, I think we talked about a couple weeks ago or last week, they do use that moving average method. And what amount of inventory write-downs for 2010 did Starbucks have? They had a reserve of $18.1 million. While this amount includes a write-down to market value, it also includes estimates of the inventory shrinkage. Do they use the direct method or the allowance method? I was going to say the same. Because of the reserve they're creating, they're using the allowance method. Okay. We already talked about these. A major criticism of the lower of cost or market rule is that it's applied only in one direction. Good point. Inventory value declines are recognized, but value increases aren't recognized. So that is a complaint that people have in the conservatism approach, but that's been going on. The lower cost of our market has been going on for ages, and I don't foresee us valuing it ever above cost. Companies don't value inventory above cost. Under certain situations, GAAP allows it, and basically it's allowed just because they're such unique items they can't approximate it. But generally speaking, you're not going to see that as much. Here's an example with ConAgra in their disclosures. Grain, flour, and major feed ingredient inventories are principally stated at market value. Our operations are exposed to market risks from adverse changes in commodity prices affecting the cost of raw materials and energy. So these risks are managed through strategies including derivatives. Commodity futures and option contracts are used from time to hedge commodity input prices on items such as natural gas, vegetable oils, proteins, grains, and electricity. So they're basically to protect themselves of their inventory being altered. They're using various financial products that you'll learn more about in advanced accounting that can be used to help. It's basically a cost in holding the inventory to protect them from vast changes in the costs there. We're not going to spend much time on that in this course because you're going to have plenty of that in advanced accounting. Okay, let's talk about the gross profit method. This is another method that can be used to value our inventory just like FIFO, LIFO, average. And gross profit method is done sometimes with the interim financial statements. And basically what we'll do is show how this method works. Know that the gross profit method isn't acceptable for annual financial statements. This is done more for an interim purpose. So basically, the way this works, we're going to take our gross profits from the prior periods, divide that by our net sales from the prior periods. That calculates what we have historically had as that gross profit rate. Then we're going to calculate the cost of goods available in the current period. We know that is beginning inventory plus all the purchases we've had. Then we're going to estimate the gross profit for the current period, by taking that historical gross profit rate we came up with times what we deem our net sales revenue in the current period. From that, we'll estimate the cost of goods sold as the sales revenue minus our estimated gross profit. From there, how we'll determine our ending inventory, we'll take all the cost of goods available for sale, again, our beginning inventory plus all our purchases, and we'll subtract from that our estimated cost of goods sold. From there, that will be our ending inventory. Here we go. So Hardin has the following information. We've got net sales of $130,000, beginning inventory at $10,000, net purchases at $90,000, and historically a profit rate of 40%. So we see the historical profit rate of 40%. We're going to take our beginning inventory plus our purchases, come up with all our cost of goods. They give us what our net sales are. We'll multiply that times what we know the gross profit rate to be to determine what our estimated gross profit is. If we take our sales minus our gross profit, we know that's going to be our cost of goods sold. The difference of cost of goods available minus our cost of goods sold will be our ending inventory. Remember that cost of goods available have to always equal our ending inventory plus our cost of goods sold. It's got to be in there somehow. So this is a way in which they can estimate based on sales how much was sold. This is oftentimes going to happen when you're dealing with large volumes and very small price costs. Gross profit method provides estimates, but the relevance of the estimates depends on that gross profit percentage, which makes total sense. That's why it's important to take several years of a historical gross profit rate. I'm not going to worry about some of those modifications. The key here is it's important to make sure that the gross profit rate, historically speaking, is accurate. Then there's something called the retail inventory method. It's used to estimate inventory when, again, we can find some parallel between purchases and selling prices. There's an advantage over the retail from the gross profit because it used current period estimates of gross profit in case there's price changes. So this method is allowed for income tax purposes and for financial reporting. So if one uses this, they need to maintain records on the beginning inventory we start with at cost and at retail value. Also the goods purchased at cost and retail, and changes in selling price that can happen as of markups or sales. And then they need to keep track of their sales. So let's look at how this would come about. As they're showing the steps here. Compute total cost of goods available. Compute the appropriate cost to retail ratio. Then compute the ending inventory at retail. We've got our retail value of goods available times our net sales revenue. Then from there we'll look at our ending inventory. So here we go. Fraser uses the retail inventory method with the average cost flow assumption and has this information. The beginning inventory at cost was 10, at retail 17. The purchases are 50,000, the retail's 83. And then the sales are at 80,000. So what we're going to do here is we of course start the beginning inventory cost and retail, the purchases cost and retail, and then we've got our total, the summation of both the goods available at cost and at retail. So you can see here the cost to retail ratio is 60%, or we can say our margin there is 40%. So if we show a comparison of our cost to our retail ratio, we can then take what we had in sales and then determine our cost of that ending inventory by taking our ending inventory at retail and then taking 60% of that and showing the cost. So basically this is just another method of being able to come up with some simple valuations for your inventory at the end of the period. We're going to go through problems like this. Okay, so they're just talking about some extra information regarding terms in the retail industry. We're not going to spend any time worrying about this, but we know markup is basically cost to the selling price. Additional markup, I'm trying to think when I've even seen that happen, an increase above the original sales price. Markup cancellations, reducing it. Net additional markups. Markdowns, we see that more, and then potentially markdown cancellations. You're not going to be tested on any of these terms. So the various methods we've gone over in the previous chapter and then also now with this chapter is, excuse me one sec. So the various methods we've gone over, along with what we've covered in this chapter, allow us to have various cost flow methods to value our cost of goods sold and also our ending inventory. So as you see here, the cost to retail ratio just creates a different valuation method. FIFO, under FIFO, if that method is applying, we exclude the cost and the retail value of the beginning inventory from the computation. Let's not go over this. I'm going to cover the basics here. Under FIFO, we're not going to worry about the specifics of the retail method. I think that's really the biggest piece I wanted to cover in this chapter. As we talked about in the previous chapter, when we're dealing with the retail method and then we start adding other costs into our inventory, it can become rather confusing and cumbersome. So that's why we're not going to spend a lot of time on it. Okay, so what I'd like to do is go over some problems. How's everyone doing? Is everyone okay?
Yeah, not too bad.
Okay, good. So I'm going to pull up the book, and we're going to take a look at a problem from Chapter 8. Okay, let me get in here. Come on, Course Smart. Okay. So let's look at on page 8-31. We're going to look at exercise 8-1. Eight 31. Eight 31. Oh. Okay. Let's look at exercise 8-1. Now I'm going to pull up the solutions here just so we can go over them. So, the lower of cost or market. Stiles Corporation uses the lower of cost or market Come on, where's my... Come on, I've got a reader in here somewhere. Okay, one more second. Sorry about this, guys.
That's fine. If that doesn't work, I know where you can get download a free reader.
And I know I have a free reader in here. Okay, Yusuf, you're sounding way different now.
Okay, hold on again.
No, you're sounding good. Good.
Oh, okay.
It's good. I'm sorry. No, you know, earlier when you were on, you sounded like you had swallowed a bunch of helium.
That's because my microphone was on a voice modification. It had like these weird voices that you can select. I didn't even know.
Well, you shocked me. Okay, so let me just open this in Word. Thank you, Nick. I should have known you were helping me out. You're so kind. Okay. I have this computer and I feel like it's getting on its last leg, but my other computer has that Windows 8.
You don't like that?
I hate it. And so I'm waiting for, I guess I've heard the new Windows doesn't have that anymore.
No, they got rid of you have the start menu like you do on the Windows 7. They brought that back.
I want to get rid of my Windows 8 and it's I'm wondering if I could just kind of reload it with the new Windows. I wonder if they'll allow me to do that. Come on. So, there we go. Come on. No, that's not going to be in here.
Are you looking at the file that you just downloaded?
Yeah.
If you click on downloads in the top left, in the left-hand corner, I think you might find it in there.
Right here?
No, go back to where you just were.
Here?
Where you were looking, yep. You see downloads? Yep. And then what you want to do is you want to change the view and make it list. Like over here, like go up a little bit more. Right there, yeah, click on that. Go back to the other one. Yep. And then go to list. And then go all the way up and you could sort it by date. Like when it was downloaded.
I can't.
I see your screen. I'm so tempted to go back to the list again. There. And then go down to details. Try details for a second.
There.
There. And then click on dates.
Normally it just opens for me.
There's a whole bunch of Word documents open on the bottom too. It could be one of those.
That's not it.
Okay, so it's not any one of those files?
No. That one,
Okay.
and then these are 2 advisory board meetings. No.
Okay.
Okay. See, it's so goofy. And it's not that big of a file.
Try saving it, see if that makes a difference.
Yeah, maybe I'll do that. That's not the form. There it is. Thank you. Why does that happen?
I honestly can't tell you, but from the looks of it, your PC is way slowing down.
It is.
And I think that's because you have a lot of older stuff. It probably needs to be defragmented, and just a lot of stuff that's running in the background could be uninstalled. This is a laptop, right?
Correct.
Okay.
I bought this November of 2012. My husband writes the date on them. And this is about one of the older computers to have it for 2 years shocks me. I've been able to keep it.
It should actually be able to last longer. It just it needs to be
fragmented.
Refreshed.
Okay. And believe me, I probably haven't done that. Okay, we got it now, guys. Lower of cost or market. So let's look at styles. They use the lower of cost or market rule for the two products in the ending inventory. A profit margin of 30% on the selling price is considered normal for each product. Specific data follows. The historical cost of product A, 68. Oh my goodness. And the replacement cost is 60. The estimated cost of disposal, 32, and the estimated selling price is at 140. Then we've got product B, the cost of 91, the replacement cost of 93, the estimated cost of disposals, 52, and the estimated selling price is 200. So basically, we're going to create the various levels to show what should be the correct inventory value for each product. So if we look in here, we've got the cost is at 68. The replacement cost is at 60. Now we'll take our ceiling and our floor. Our ceiling is the selling price minus the cost of disposal, which is 108. Our floor includes the profit margin. So it's going to be the 108 minus the 30%, or $66. Okay? So as you see here, our cost is at 68. We've got a replacement cost here at 60. But we can take the floor here of $66 as the replacement cost, as you see here. So basically, we've got a loss here of $2. The net realizable value less a normal markups used because the replacement cost is less than the floor. And the net realizable value less a normal markup is less than cost. So since this is less than cost, because this is the floor, we're going to have to take a $2, the new inventory valuation will be $66 on this one. Product B, we've got our cost of 91, our replacement cost of 93, we've got the net realizable value of 148, and then our floor is at 88. Now in this case, we're going to keep our same cost because the replacement cost is between the ceiling and the floor here. So you see, if you look at this, the ceiling's at 148, the floor's at 88. The replacement cost is right in between here, therefore we can keep our cost as 91. In our product A, our problem here is our replacement cost wasn't in between our ceiling and our floor. That's what made us have to take the floor then. Okay. Let's go back here and look at the 2. What effect does the imposition of the constraints on market value have on these various limitations? Well, when we use under A, the floor prevents the write-down of inventory below its expected utility. If the floor constraint weren't imposed, we would have a really big loss in the write-down of the inventory. Yeah? So as you see here, if we didn't have our floor in this product A, and we couldn't stop just with the floor portion, and if we had to write it down from 68 to 60, it would be a significant loss here. But being able to use these constraints limited us to only having to write it down to 66. With B, there's no effect on the floor or ceiling because the replacement cost is in the middle. Okay? Now I want to look at, let's look at 8.2. 8.2 basically says the following information is taken from Aiden's records. So we've got various products, groupings, units, costs, and market. What is the correct inventory value if the company applies the lower of cost or market to each of the following? So the first thing we're going to do is take each individual item and apply it. Then from there we'll take the group, and then from there the inventory. So as you see here, we've got the product, the group. Here in units, we've got the cost per unit and our market value per unit. In this scenario, we've got our cost per unit. Our market value is higher than our cost per unit. In this scenario, our cost is lower than our market value. In this scenario, product D, our cost per unit is $6.50, but our market value is down at $6.40. And then also in E, our cost is at $25, our market's at $24.60. So the key here is to see how the loss is going to be, the amount of the loss based on using it individually and then per grouping. So as you see here, the cost was 5, the market was 5.10, so we're going to stay at cost. Here the cost was 5, the market was 5.30, we're going to stay at 5. In the third scenario, the cost was 5, the market is 4.70. We're going to put it down to 4.70. In case 4, the cost is 5. When the market's 4.10, that's what we're going to use, 4.10. And then in case 5, the market's at 5. Excuse me, the cost is at 5. The market value is at 4.70. Therefore, we're going to put it at 4.70. Here, let me just make sure I'm on the wrong one. That's why it wasn't making sense. Okay, here we go, guys. 8.2. So the correct inventory value. So we've got our case 1, 2, 3, 4, 5. This gives us our net realizable values. This gives us our realizable values minus the normal profit. And here's the replacement cost. Now, again, remember, if the replacement cost is lower than our cost, then we need to look at the ceiling and the floor and see where that replacement cost is. So with 1 and 2, as you saw here, we kept our cost because the market value was higher. When we look at 3, we've got the cost of 5. The replacement cost is $460. But is that replacement cost in our ceiling and floor, in the middle of our ceiling and floor? It's not. Therefore, the only amount we need to write it down to is $470 here, because our floor is at $470 and the replacement cost is lower than our the replacement cost at $460 is lower than our floor. Here the cost is at 5. The replacement cost is at $410. If you look at our ceiling, it's $420, our floor is at 4. So we can take $410 because it's in the middle of our ceiling and our floor. And then the last one is our cost is at 5. Look at this. We've got our replacement cost is at $480. But our ceiling is at $470 and our floor is at $460. We can't take the replacement cost because it's not in the middle of our ceiling and floor. Therefore, we'll take the ceiling here of $470. Does anyone have any questions on that? Does that make sense? Does that sound okay, guys? Now let's move on to E3, 8.3. This is the one where we've got various products and units and the market prices. We're going to determine how this is going to fare out using individual items, then by group items, and then inventory as a whole. So we've got our products, our groups, our units. As you see here, our market price is at 80 cents, where our cost here is at $1. In the second one, our cost is at $1.50, our market is at $1.55. So our cost is lower. In C, our cost is lower than the market. But in D, our cost is higher than the market, and same with E. So this one will help us see how these amounts are going to fare using them individually, and then also using them as groups and as a whole. So if we take the lower of cost or market, the first one we're looking at, our cost is at $1, but our market is down at 80 cents. I might have said that wrong. So we've got to take the market value here because it's less. So 600 units times 80 cents gives us our value of 480. For B, the 250 units, we've got a cost of $1.50, but the market value is $1.55. So in that case, we can take our cost of $1.50 at 250 units, $375. For C, we can take our units at 150, and our cost is lower than the market, so we can take our cost of $5, 150 times 5. For D, we've got 100 units, cost at $6.50, market at $6.40, so we're going to need to take these units at $6.40 as shown here, $6.40. And then finally with E, we're also going to have to take the market price because it's lower than the cost. So our total inventory value using each individual products are 4213. Now if we take the items and write them down as groupings, so groupings mean that group 1 we're going to combine, group 2 will combine, and group 3 will combine. So group 1, we're dealing with 600 units at 80 cents, 250 units at $1.50. So we've got our 600, our cost here is $9.75, but when we come up with the market value, we're at $8.67. So what we've done here is we've combined the costs here, and then in this scenario we've also shown the market value here. So the lower of cost or market is going to be the $8.67. In this scenario with group 2, C and D, we're going to combine the costs at $1,400, but look at our market. We're taking the market on both items. It's at $1,427.50. So in this scenario, we don't have to write down the product D because that was reduced, but we don't have to write that down because the lower of cost or market for the grouping is still the cost. And then in group 3, we've just got one product in here. We're going to have to write that one down. So the lower of cost or market as a grouping is $42.35.50. Now this is interesting. This amount, of course, is going to be greater than when we take those individual units. Now when we take them as a whole, we're taking each product and we're totaling all the costs, and then we're totaling all the market values. And as you see here, the total inventory value here is $42.63, which again is higher than our groupings. And the cost was $43.75. We're down a little more than $100 in our reduction in our inventory when we take it in full as an entire inventory. Now let's look at E4. E4 basically looks at these inventories for Berry Company. Berry uses a perpetual inventory system. Assume the inventory that existed at the end of 2013, so December 31st of 2013, was sold in 2014. Prepare the necessary journal entries at the end of each year to record the correct inventory valuation if Berry uses the direct method or the allowance method. So as you see here, by either method, on December 31st we had a cost of $13,000, but the market was at $11,500. So we're going to have to write that down, that $1,500 spread there. The same with December 31st of 2014. The cost was at $15,000, but the market was at $14,000. So we're going to need to show that write down. At the end of the first year, using the direct method, we're going to go right against cost of goods sold, $1,500, reduce our inventory by $1,500. And then under the direct method in 2014, we'll write down cost of goods sold of $1,000, reduce our inventory by $1,000. Now the allowance method does not go directly against our inventory and cost of goods sold. So we would have to show here that we have the first year a debit to loss due to market valuation of $1,500, and then a credit allowance to reduce inventory to market for $1,500. During the year, we will show our cost of goods sold at 11.5 because it was all used up. Here's where we'll debit our allowance to reduce inventory to market, and we credit our inventory of $13,000 because we sold it. So we're going to take that allowance at that time. In December 31st, we'll show again our loss due to market valuation of $1,000 and then credit our allowance to reduce the market to inventory. Now the second part asks us, explain any difference in inventory valuation between the two methods. Basically, we're going to end up with the same results here. Ultimately, they're going to have the same net inventory valuation and the same effect. At the end of 2013, inventory would be valued at 11.5 and income would be $1,500 lower. At the end of 2014, both methods report the same net value for inventory and have the same effect on income. The difference here with our allowance method is we show our loss right away. Instead of crediting our cost of goods sold or debiting our cost of goods sold, we're debiting our loss. We hold on to that allowance until the entire inventory is sold, and then when we show our cost of goods sold, to be able to reduce our inventory to the full amount, we'll offset it with that debit to allowance to reduce the inventory. Okay. So ideally, the allowance method allows you to really see how that inventory was written down. Okay, let's take one second here. Let me find one more and then we're going to be good. Okay, let's take problem 8.1. Problem 8.1 is going to be your homework. I think, what did I say the homework was in this chapter? Let me see. Eight 8.1 and 8.17. Let me see what 8.17 was. Okay, so let's go over 8.1 and 8.17. Okay, so with 8.1, problem 8.1. Palmquist has 5 different inventory items that it values by the lower of cost or market rule. The normal markup on all items is 20% of cost. The following information is obtained from the company's records. So the first thing we want to do is compute the lower of cost or market for each item. So if we show here in item 1, cost is 10, the net realizable value is 920, and the replacement cost is 910. What would we use for our market price? So we don't have the floor, do we? I think we're going to have to compute the floor on this because the normal market is 20% on all items. So let's go and look here at problem 8.1. And as you see here, the first thing we'll do is show the cost. We've got the replacement cost is at 910. The net realizable value is at 920. the net realizable value less the markup is at 720. So we've got the lower of cost or market here to be 910. Why? Because it's in the middle of the ceiling and the floor. Excuse me one second. Okay, does that make sense? Now the next one, our cost is at 8, the replacement's at 810, our net realizable value is at 780, and then our floor is at 620. Now the problem here is our replacement cost is not in between the ceiling and the floor, so we can't use that. So we're going to need to use the ceiling in this example because the replacement cost is greater than the cost, but if you look at the ceiling, that is lower than our cost. So we're going to have to use the net realizable value in item 2. In item 3, we're going to use the replacement cost because if you look at the ceiling and you look at the floor, it's right in the middle of the ceiling and floor. So in that case, we'll use 1350. For number 4, you look at the ceiling, you look at the floor, but look at the replacement cost. It's below the floor. So we're going to only use the floor, the net realizable value less markup, to write it down to. And then last, we've got a cost of 25, replacement of 25.50, our ceiling's 25.30, and our floor is $20.30. So in this case, we're going to keep our cost right where it is. Number 2, the second part asks, compute the total inventory value if the lower of cost or market is applied to each individual item and the inventory as a whole. So again, if we look at each individual item, we know from part 1 what we're going to use. So you can basically take these figures from part 1 and total the inventory to be 16,900. Now, and sorry I'm going over that so fast, but basically here are the values here, and by taking those values we see that the total inventory is 16,900. When we go and we take the inventory as a whole, what we'll do is we'll take the inventory at cost, then the inventory at market, and we total them. So at cost, our inventory is at 18,800. At market, our inventory is at 16,930. So we will take 16,930, which again is a little higher than what we had when we dealt with the individual items. The difference, the $30, is caused by the item 5 there. Then number 4 asks us, compute the lower of cost or market for each item if Palmquist uses IFRS, and we're not going to even worry about that because we didn't even discuss IFRS. So don't even worry about that one. Now as we move on to 817, I believe it is. Problem 817, I believe was your homework unless it was 816. Okay, errors. As controller of a company which uses the periodic system, you discover the following errors in the current year. Merchandise with a cost of $17,500 was properly included in the final inventory, but the purchase was not recorded until the following year. So the question here is, indicate the effect on the ending inventory and the net income for the current year and the net income for the following year. So if you think about this, the cost of $17,500 was in the inventory, but the purchase wasn't even recorded until the following year. So how did that purchase, those costs weren't even in there. So what's happening, if you think about it, that purchase price of purchasing that inventory didn't get added to all the cost of goods available, okay, for the year. It was in the ending inventory, but it didn't get added to all the cost of goods that would be available. So basically, when they came up with the cost of goods sold, there wasn't enough in that cost of goods sold. The cost of goods sold should have been greater than what it currently was because the purchase wasn't added to all the purchases available. It was in the ending inventory, but it wasn't a part of all the cost of goods available. Therefore, the cost of goods sold was understated, which makes our net income overstated. Okay? The next one says, merchandise purchases are in transit under terms FOB shipping point. So FOB shipping point means we're going to pay for the shipping, which we should have title. They've been excluded from the inventory, but the purchase was recorded in the current year on the receipt of the invoice of $4,300. So if you think about it, the purchase is in the books, but that inventory wasn't included in the ending inventory, and it should have been because we had title to it. So ending inventory is understated by $4,300. The net income gets understated because the cost of goods sold was overstated. So the purchase was in there, but it wasn't part of ending inventory. So again, our income is understated and our ending inventory gets understated. Then goods out on consignment have been excluded from inventory. Okay, these are our goods that are out on consignment. They should have been included in our inventory. So because they weren't included in our inventory, they've been getting excluded from the ending inventory. So the ending inventory is getting understated, which basically means our net income also is getting understated because our cost of goods sold is being overstated. Merchandise purchases under terms FOB shipping point. Merchandise purchases from FOB shipping point have been omitted from the purchases account and the ending inventory. The purchases were recorded in the following year. So basically, the purchases were omitted and they were omitted in the ending inventory. So, sorry, I'm getting these text messages. I apologize. So, the ending inventory is understated because it's not including those purchases. Now, it's not going to affect your net income because the purchases weren't even shown in the information, so that's not going to affect each other then. We'll have to go back to the second year because I haven't touched on those. Goods held on consignment from Talbert Company were included in inventory. So basically, we're showing greater inventory than we really should be because they're not our goods. They shouldn't have been included. So our ending inventory is overstated, and as a result, our net income gets overstated because our cost of goods sold was understated. They shouldn't have been included in our ending inventory. So since that's being overstated, our cost of goods sold got understated. If we go back, I think I'm going to, because I need to start at 7:30. I told everyone we'd work on that. You guys take time to look at the second year, how those effects happen and get either corrected, or based on the second year, how it, because of those inventory issues, how it affects them. Generally, inventory items ultimately correct themselves between the 2 years, but the problem is that in the appropriate year that they should be recorded, they're not. So usually in the following year, they will correct each other out. Now, of course, in the situation where inventory is consignment, I mean, that just shouldn't have been at all in that case. So, guys, I am going to end this portion here.